You'd be very unlucky to hold all 4 of these investments in your portfolio, but I can virtually guarantee you'll have at least one of them, probably 2, which means you need to act now. Because once they start to collapse, market panic will spread and everyone will be desperate to get out. This could be your last chance to avoid getting caught in the crush. You've heard of the 4-minute warning, I'm sure. It was a British public alert system set in place during the Cold War. It gave the approximate length of time from the point a Soviet nuclear missile attack against the UK could be confirmed, and the impact on its target. Essentially, it gave you 4 minutes to decide on a course of action before disaster struck. Well, today, a series of financial disasters are heading towards us, even as we speak. Any one of them could send Britain plunging into a new wave of economic turmoil. When they do, you will have very little time to react, let alone prepare. This will affect you, because it will hurt everyone's wealth. But there is something you can do immediately to protect what you have, and even turn these events to your advantage. Today, I'm going to tell you exactly what we think you should do right now to safeguard your wealth. What's more, I'll reveal 3 simple survival moves you can make immediately. We believe they will grow your net wealth through what's to come. That's why I'm presenting this to you today. In fact, that's why, as the UK's best-selling independent financial magazine, we're issuing our own 4-minute warning. These are 4 investments that we believe you need to dump right now. Because if you hold them in your portfolio, we believe they'll eat away at your wealth and everything you've worked so hard to build up over the years. Frankly, it's vital you understand the severity of what we are facing. So I want to get straight to the 4 toxic investments that could be poisoning your wealth from the inside if you have any exposure to them whatsoever. Toxic investment number 1. Get out of the property market now. Between 1996 and 2007, investing in property looked like a dead cert. All you had to do was buy property and then sit back and watch it soar in value without lifting a finger. It was the nearest thing to free money you'll ever see, and people got drunk on it. In fact, they got so drunk they became deluded and thought it would never end. Then, the great crash of 2008 came along and ended the property boom, just as we at MoneyWeek magazine had predicted. For a while it seemed as though prices would never stop falling. In the space of just 9 months, house prices lost nearly 20%. But now, for the most part, it seems like prices have stabilised. Even though 2011 was hardly a vintage year for the property market, the average price of the UK home now stands at almost £165,000, 9% higher than in March 2009. So is now the time to pile back in? The truth is, no one can know for sure, but we have our own idea about what will happen, just like we did back in 2007. We believe the entire rebound of the last 2 years to be a dangerous false dawn. One that's lured UK investors into more danger than they ever imagined. Those who buy today could see the value of their investment plummet within the next 6 to 12 months. It's not what politicians, lenders and house sellers want you to hear, but there are several factors pointing to the property crash restarting in the very near future, if it hasn't already. You see, right now, the coalition is desperate to keep the public on side and continue the illusion of being in control. Why? Because they want people to believe that their homes will go up in value forever. When people's houses are worth more, they feel richer. They're more likely to spend their money and vote the right way in the polls. So the government will always step in to try and stop the inevitable. They'll prop up the market by any means possible, because they must be seen to make decisions, even if those decisions are ultimately dangerous. And that's exactly what happened in 2008. They slashed interest rates, held off stamp duty, and recapitalised the banks, urging them to lend to would-be buyers. Naturally, the market responded. Property prices quickly bottomed out. But the fact is, the property market should have crashed in 2007. And if the government had left it to run its course, yes, we would have seen a worse dip, but nothing like the catastrophe now lying in wait. Firstly, let me be clear. We are not suggesting that you sell your family home for any price you can get. Not at all. What we are saying is that now simply isn't the right time to buy. And if you're a property speculator, now is probably the right time to sell. Dig beneath the surface and you'll see the UK housing market is more fragile than even the most bearish headlines suggest. For starters, bankers are still terrified to lend. It's still hard for would-be buyers to get a loan. Many current mortgage offers require a 25% deposit. While there are some 90% loan-to-value mortgages to be had, they are both costly and rare. Less than 2% of loans in 2011's second quarter had a 90% loan-to-value ratio, says the FSA. In fact, total mortgage lending fell by 4% in October 2011, says the Council of Mortgage Lenders. In October, only 76,042 mortgages were approved in the UK. That's below the 90,000 a month average since 1993. Put it like this, even right before the crash in 2008, things were much, much better than they are today. Yet one thing remains the same. UK property is still massively unaffordable. Do you really think that house prices have dropped to a reasonable and fair level? The government may insist we're through the worst, that we've survived, that the property market is back on an even keel, and unfortunately many people swallow this. But here at Money Week magazine, we don't have an agenda or any vested interest in telling you one way or the other. We tell it exactly as we see it, and here's what we see right now. From 1983 to 2001, the average mortgage was 3 to 3.5 times an average person's salary. By 2007, it had risen to above 6 times. Although affordability improved when the bubble burst in 2008, recent house prices have driven this ratio back up to critical levels. In fact, the current affordability figure is now at 4.4, a whisker below what it was at the height of the previous property boom back in 1989. You won't hear that from the government though, or any estate agent. And here's something else they don't like to admit. Even though it could be the single biggest threat to the UK property market this year and the next, interest rates can only go one way, up. And that's dire news for property. Right now, the Bank of England's artificially low interest rates are easing the burden on overextended borrowers, enabling many owners to keep ticking over while seducing the few buyers who can afford it into taking the plunge. These super low rates may have bailed out some property investors for now, but the Bank of England can't keep rates low forever. They'll have to raise them eventually. In fact, Mervyn King hinted after the last MPC meeting that rates could rise as soon as May. When they do, repossessions will skyrocket as thousands fail to meet their monthly payments. Many overstretched landlords in the buy-to-let market will be unable to cover the shortfall between the cost of their mortgage and their rental income. Then they'll be forced to sell at once for any price they can get. It all means more houses hitting the market when it'll be least able to absorb them. The truth is, all the signs are that property prices will fall. It's not all bad news though. There are moves you can make to protect yourself and even increase your wealth when property prices come crashing down. Among them, you'll find one of the best investments you can make. An investment you can hold for the next decade, which you should be able to ignore the whole time. Quite possibly, you'll end the period far richer than you ever imagined. I'll tell you more about it in a moment. First, the most crucial thing to do is warn you of the next toxic investment that could be poisoning your wealth from the inside. Toxic investment number 2. Dump the FTSE before it's too late. Today, you look at the FTSE 100 and it's almost hard to believe a meltdown ever happened. Sure, stocks have taken a few knocks since March 2009, but each time they've come right back up. Even after the most recent setback, a 15% crash at the end of July and the start of August, investors have piled back in and pushed the FTSE almost halfway back. Unsurprisingly, many analysts are pretty upbeat about where they're headed. We are currently in a situation where there will be a lot of turbulence and volatility. Investors need to expect that, says Mike Clarfield of Clearfield Investors. Yet, while we continue to be cautious, it is also important to hold your nose a little bit and start investing based on a disciplined approach. It is time to start incrementally adding to equities. Ashton Bradbury, manager of Old Mutual's Asset Managers UK equity team, is also bullish on the FTSE. We feel that the UK market is cheaply priced, and that earnings expectations look reasonable with good rates of company profit growth coming through. Companies are financially strong, and we're starting to see merger and acquisition activity begin to pick up. So we feel that the good fundamental prospects for the UK market should come through, taking the market higher again over the next 12 months or so. But investors who see the market as a one-way upward street are missing the point entirely. Today's stock market has been pumped up by company cost cutting, not real profit. Company profit is the real key to the stock market. If companies make more money over time, shares will rise. And sure, profits have been climbing recently. But the truth is, the only way most businesses, large and small, have survived so far has been by taking an axe to the workforce. This is giving companies the appearance of growth, when really, they've just cut costs to the bone. But you can't cut costs forever. Real growth and demand has to take over from the cost efficiency for a true recovery. And right now, we're seeing nothing like that. If corporate Britain is going to keep raising its profits, it has to kickstart real growth, i.e. sales have to start growing. But where will they come from? After all, unemployment is near double-digit levels in the US, and the UK isn't far behind, and that's bad news for stocks. The fact is, we're in uncharted territory, and it's a very dangerous and unstable situation. On a national level, we're drowning in debt. Britain now owes more than $1 trillion for the first time in its history. Against that backdrop, we're about to enter the biggest era of spending cuts in our lifetimes. Consider all that again and ask yourself, does a 50% rise in the FTSE, an 11% rebound in property prices in just over 2 years seem right to you? The way we see it, these aren't healthy markets at all. They're not even recovering markets. These are grossly inflated markets, pumped up by desperate government intervention. Of course, there are things we know now and things we'll have to wait and find out. Will the UK economy sink into deflation if the government follows through its pledge to rein in our national debt? Or, with the Bank of England's furious attempts to keep the ball rolling, is it inflation we have to fear? In truth, it all depends on what our financial authorities decide to do next. And that's what concerns us more than anything. The very same people who got us into this mess are using the very same toxic policies to try and get us out. The Bank of England has already pumped $275 billion into the economy through quantitative easing. The Fed has made similar moves in the US on an unprecedented scale. This new money is not backed by gold or sales of cars or wheat or Barbie dolls or anything. It's just made up out of thin air. Is it really any wonder house prices have been going up when nobody's buying? Or that shares are rising when real profits are down? But as investors throw money into any old stock and property, we think caution is advisable. Especially the kind of informed caution that saves your skin when everyone else is losing theirs. And while Money Week magazine seeks out ways you can profit no matter what the wider economic situation, I'll come to these protect and profit moves in a minute, we also warn of dangerous trends that could profoundly affect your wealth, like this one. The third toxic asset we think you should avoid at all costs. Toxic investment number 3. Drop the euro before it completely collapses. As I write to you, Europe is teetering on the brink of collapse. The sovereign debt crisis threatens to destabilize the whole continent, perhaps taking the single currency with it. With every passing day comes a new and shocking twist, each wave of bad news edging the Eurozone to a point of brutal definition. The way we see it, the ongoing crisis in Europe can only end in one of 2 ways, and both could mean disaster for the euro. The crux of it is this. Europe survives as a deeply dysfunctional marriage between 2 economic groups. On one side, you have the naturally conservative northern states led by Germany. Their saving and investment rates are high relative to income, with their personal borrowing and spending low. On the other side, you have the pigs countries, Portugal, Ireland, Italy, Greece and Spain, who are the exact opposite. Their debt levels are unsustainable. Rising unemployment makes it difficult for individuals to repay their debt, and lower tax income makes it impossible for their governments to service their borrowings. Now, most experts will have you believe that this problem can be solved with short-term bailouts and austerity measures, but that's just it. Things have got so bad it's simply too late. The growing crisis has already left many economies in its wake. Portugal, Ireland, Greece and Italy have all succumbed to their own astronomical debts. Ultimately, they drowned beneath steep, ever-rising borrowing costs as the market lost all faith in the basic solvency. Take Portugal, for example. Its combined private and public sector debt adds up to well over 200% of its entire annual income. How serious is that? Well, imagine owing the bank twice your yearly salary. You could cut back on new clothes, going out, even food. But the fact remains, you've already spent 2 years' worth of your future income. The only way you can survive is by borrowing more and getting deeper and deeper into debt. Eventually, you'll struggle to even pay the interest. And that's precisely what happened to Portugal. In April, it had to wave its begging bowl under the noses of EU and IMF chiefs for up to 80 billion euros just to keep going. Meanwhile, in Ireland, the government borrowed almost 85 billion euros in an attempt to save its crumbling banking sector. That's a staggering 50% of the country's entire GDP. The cash-strapped Eurozone had no choice but to come up with the cash. That's because if Ireland's banks collapse, many other European banks who've lent them money will also be in dire straits. The big threat to European recovery is that defaults on its periphery could restart a banking crisis, says Ronald McKinnon at Stanford University. As for Greece, don't ask. Its 10-year bonds, a key measure of financial stability, hit a staggering 18% in May. That's when Greece reached breaking point. In other words, that's what the Greek government could have to pay for long-term funds. Of course, there's no way on earth Greece will be able to do that. In fact, Greece will default on 50% of its debts, weakening the Eurozone further still. In the last few months, the situation has turned critical. Italy's rising borrowing costs hit the infamous point of no return, 7%. Italy's government will need to borrow 362 million euros next year just to repay the interest on its loans. The country now faces a financial, political and social crisis not seen since World War II. And the fearful market is already sniffing around for the next victim. Recently, Spain's borrowing costs hit 7% too, a point from which no other Eurozone bond market has yet recovered. The European Central Bank may have bailed out Portugal, Ireland and Greece, but they simply do not have enough money to bail out everyone. And still the contagion spreads. Beyond Spain, France is looking vulnerable. In recent months, 2 of its largest banks have been downgraded, and in mid-November its corporate bond market was hit by a sharp sell-off. Suddenly the market is starting to back away from France with a sense of real fear. If France is the next country to be severely weakened by the debt crisis, then all bets are off in terms of financial stability of the entire European Union. That's how bad things are in Europe right now. If any more of the PIGS countries admits that they can't repay their bondholders, or a major economic power like France begins to look like going under, well, there can only be 2 outcomes. 1, the European Central Bank will print more money, trashing the spending power of the euro. Or 2, the Eurozone will not be able to overcome this crisis and break apart. Either way, it will be catastrophic for the single currency. Now, of course, there's much more to this story. Much more. Too much to cover here. That's why today, I'd like to invite you to try out 3 free issues of our unique magazine, Money Week. Each week we tell you not only what is happening in the world of money, but more importantly, what it means. What we're really seeing with the faltering euro is a consequence of where the state has too much control over the financial markets, and when people have the power to meddle with the economy, sooner or later they will destroy it. Thankfully though, we've got wind of a clever but very simple way to play this deadly trend for potential profit. It doesn't come without its risks, but by reading Money Week you'll learn everything you need to know about these kind of tips. In fact, I'd like to invite you to share in the same vital, time-sensitive information that will put you squarely among the country's investment elite. Simply click on the link appearing below to claim the first of your 3 free issues, and this kind of information is yours. I hope you take up our offer, because with the financial situation as precarious as it is now, you must tread very carefully if you want your wealth to grow, no matter what happens in the wider economy. That's why, while Money Week magazine tries to seek out the best protect and profit moves for your money, it also warns you of the big dangerous trends and the deadly investments coming out of them, like this final one, perhaps one of the most widely owned assets in the UK. Private investors, pension funds and private client fund managers all use it for a big portion of their portfolios. And yet, it could be the single most toxic investment on the market today. Toxic investment number 4. Beware, the bond bubble is about to burst. Since the election last summer, the flow of money into UK government bonds, gilts, has continued apace. And in our view, it's unsustainable. Of course, it's easy to see why so many investors are putting their money into government bonds. They want a safe return. And sure, over the past decade, holding bonds was a considerably safer option. But that means prices have now been driven up so much that yields are at rock bottom levels. 10-year gilts, for example, yield just 2.2%, less than the rate of RPI inflation. In other words, buy bonds today and you're losing money. Think about it. Would you lend money at 2.2% for 10 years to politicians? No, and we don't understand why anyone else would. But investors are. In fact, almost everyone is. In a nutshell, we believe gilt yields are now as low as they are likely to get. They have nowhere else to go, and all the risk is that bond prices will fall. The bond market is a bubble, says Robert Froelich, Senior Managing Director of the Hartford Financial Services Group. And it's getting ready to burst. When that happens, you do not want to be holding government bonds. So if not bonds, what should you be doing with your money right now? First, let me explain why you should heed these warnings. My name's Toby Bray, and as publisher of Money Week magazine, I have the privilege to work with some of the most dedicated writers, analysts, and expert financial researchers in the UK. And I couldn't think of a better time to have them on your side than now. Since 2000, we've been scouring the financial news, drawing on our many contacts in the city and across the world to bring readers right up to date with the latest investment trends and opportunities. Time and time again, we've stuck our neck out with reports like this one, usually going 180 degrees against common opinion. But it's been well worth it for our readers, who've profited and protected themselves from our past insights. For example, in July 2008, we warned that sterling was massively overvalued against the yen and the dollar. In the following months, the pound began to collapse. We even recommended a number of ways to profit from sterling's fall. We saw the credit crunch coming a mile off. Our readers were ready and waiting. We predicted the price of crude oil was going to surge as far back as August 2002. We told our readers so and identified which oil shares to buy into. Readers who acted on our advice made a fortune. Just take what happened in April 2005, for example. We suggested it might be worth looking at 3 resource shares to play the commodities bull market. Those 3 shares, Heritage Oil Corp, Geralia Resources, and Uruguay Mineral Exploration, went on to make an average 349% gain over the following 2 years. Starting in October 2006, we published a whole series of warnings that property was about to crash. It was the height of the property bull market. Everyone thought it would last forever. But we've learned over the years that when everyone's thinking the same, no one is thinking at all. In the autumn of 2006, we ran a centerpiece on the dangers of free and easy lending to subprime borrowers. But it was in 2007 that we sent out our most urgent and direct warning. Get out of property now. We all know what happened next. Fortunately, our readers had plenty of time to prepare and shift their money into the opportunities that we uncovered. And that's really our primary goal here at Money Week magazine, to inform you of the best places you can invest your savings. Where do we think you should be putting your money today? I'll be frank, right now we are very bearish. Most investments are dangerously overpriced. The wider economic situation doesn't look any better either. On the one side, you have a whole army of bankers, politicians and economists fighting for a system based on debt and counterfeit money. On the other, there's a legion of bad loans created by the credit boom still poisoning the financial system. The fact is, this crisis is simply not resolved. The bad debt has not been worked out of the economy, and until it's dealt with, most investments will suffer in the years ahead. So what should you do? Survival action number 1. Buy defensives and bear market protectors. Like I've said, we believe the FTSE is vulnerable to some nasty surprises. While printed money continues to prop it up, it may not collapse. But, with potential risks ranging from inflation getting out of hand to another panic in the Eurozone, we wouldn't stake our future retirements on it. But there is a silver lining to this, if you're willing to take action today. You see, there's a very special group of defensive stocks that thrive in situations exactly like this. These kinds of companies don't need economic growth to make money, because people have to spend on their products out of necessity. In short, they're specifically suited to keep your portfolio ticking over in times of upheaval and grow when the market truly recovers. Buy in today, and not only are they likely to help your wealth survive any violent correction in the wider stock market, they could also make you some serious money in the years ahead. We'll be looking more closely at this sector over the coming months. To get our recommendations and analysis, take a free trial by clicking on the link below right now. But it's not just purely defensive stocks we think you should be investing in. Survival action number 2. Get the right dividend payers into your portfolio now. Dividend paying stocks have had an unusually hard time since they fell out of fashion in the dot-com years. Why? Because the emphasis was on capital gains from risky, fast-growing technology firms. But since the bust-up of 2008, investors have rediscovered the appeal of dividend checks. This is for 3 reasons. Dividends outperform bond yields. According to Bloomberg, by the third quarter of 2010, more US stocks were paying dividends that exceed bond yields than any time in the last 15 years. Dividends can't be fudged. They have to be paid with real money. And with markets so volatile, jobs on the line and interest rates at historic lows, real money is important to investors. Dividend payers are excellent stocks to own in times of unprecedented uncertainty. Dividends contribute to share price stability. If the share price of a dividend-paying firm falls, it is likely to fall less sharply than a pure growth stock. That's because, as the price falls, the yield tends to pick up, encouraging investors to buy back in. Here at MoneyWeek magazine, our experts have found 8 high dividend-paying companies you can invest in right now. To get the full details of these recommendations, why not try 3 free issues of MoneyWeek? Simply click on the link below to claim your free trial. But before you do, make sure you're well positioned to take survival action number 3. Ride gold all the way to $2,230 or even more. Here at MoneyWeek, we first recommended our readers buy gold in November 2001. Back then it traded for under $290 an ounce. Today it's around $1,700. That's an incredible 486% rise. Take a look. Over the last 10 years, just holding gold would have quadrupled your wealth. From 1999 until now, all you had to do was own gold, and without the help of a single fund manager or other expensive advisor, you could have more than quadrupled your wealth. And that's one of the crucial things we at MoneyWeek magazine advised our readers to do. But, in our opinion, this could just be the beginning of gold's rise. During the 1970s and early 80s, the yellow metals soared 2,329%. We're not even a fraction of that move today, at just 486% in gains since 2001. And that's despite the fact that today's markets carry an even bigger surge of demand, much tighter gold supplies, and the huge threat of more debt, paper money and real-term inflation than at any other time in history. If gold was to rise today from trough to peak by the same percentage move as it did in the 70s, you're talking an eye-popping spike to near $23,450 per ounce. Now, we're not saying it will go anywhere near that high. In truth, we pray it won't, because to see that happen, you need to be following the news from the safety of your bomb shelter, as all around you civilization breaks down. But the fact is, today, we're locked in a period of intense confusion, and during times of confusion, gold often performs better than most other assets. That's why we think gold will go much higher than it has so far. Consider this. Adjusted for inflation, the 1980 gold peak of $850 gives you a price of $2,230 still on the horizon today. That's more than enough for you to make a fortune on the next gold move. And right now, some of the world's most renowned gold experts agree. Roger Weigand of Trader Tracks forecasts gold at a minimum price of $2,960 per ounce, with a probability of much higher prices. CLSA's Christopher Wood reckons gold could go as high as $3,500. Meanwhile, gold expert and best-selling financial author James Turk recently said that as early as 2015, we could easily see gold at $8,000 per ounce. That's over 370% higher than where it trades today. The question is, which gold investments should you be buying today?